All right. Good afternoon if you're joining us on the East Coast, and good morning if you're anywhere west of East. Welcome to the Bisnow Town Hall. This is a weekly and very regular series here. We're hosting in the Washington region and across the United States, Canada, the United Kingdom, and all of our global subscribers. This is a weekly series in which we are hearing from the leaders of commercial real estate companies and institutions, how they're running their companies and organizations, what they're seeing in the marketplace right now, and how they're making sense of these crazy times. These are free to attend and widely promoted. It is our goal and intention here to share the insights of the men and women who are leading our industry through these times and the resulting economic impact. A couple of notes. To all of our attendees, you are on mute, so we can't hear you, don't worry. It's a video platform, and some of us are dialing in from home. If you experience a slight delay, that's totally okay. Log back in, log out and log back in. And Jeff and Roger, that goes for you too. If something crazy happens, just log out and log back in, and everybody hang tight. We'll get back on. It'll take about 20 or 30 seconds. It's totally okay. There is audience Q&A, and we invite you to send in questions to Roger and Jeff. Just go on the right-hand side of your screen, send in questions. You can also upvote other people's questions as well. And the biggest note is, don't worry if you miss something. We're going to send around a link to a recording of our webinar to everyone who attends. I'd like to thank our sponsor this morning, Friedlander Missler. Friedlander Missler is a boutique Washington, D.C. law firm specializing in all areas of commercial real estate for over 50 years. They provide exceptional legal counsel to some of the area's largest real estate development firms, as well as the majority of the local community banks. Times are very uncertain right now. You need trusted partners to help you through these things. Go to Roger and his team at Friedlander Missler. Our speaker this morning, Jeff DeBoer, CEO of the Real Estate Roundtable, and joined by partner Roger Simon of Friedlander Missler. And you might not know this about Jeff. He is an avid guitar and rock and roll guy, as well as an eclectic music fan of all tastes. And kicking off this morning, Kenny Rogers, we are accepting all recommendations for future songs here at the Bisnow Town Hall. The lines are in, so please call in your request. Roger, Jeff, good morning.
Hey, how are you?
Good morning.
Good morning.
Nice to be here. Great to be here.
So, without further ado, Mike, I think we'll start this off. My name is Roger Simon. I'm a commercial real estate attorney in Washington, D.C., where I've been practicing since 1993. So I've been through a few various cycles, and this is currently the most interesting of them all. And I'll turn it over to Jeff and talk about the CARES Act. Now, Jeff, in terms of the PPP program, both the first phase and the second phase, are there parts now that you think need to be changed?
Well, of course. Yes. First of all, thank you for having me. It's very important. I'm happy to be here and to try and get a little bit of clarity on what's going on in Washington, what policymakers are doing, what they should be doing, what they're doing that might not be correct. And so I'm anxious to talk about this. I'm anxious to get questions on it. Sure, I guess I would start by saying, what is Washington? What did Washington try to do when they did the CARES Act, and what was it all about? And really, in many ways, it was about bridge financing or bridge term help. That's how I think of it anyway. You know, we were trying to help people and businesses get through what was coming to be the peak activity of the virus. And the idea was almost to put the economy in a deep freeze, so to speak, for a few months, and then hopefully unthaw it. And so what Congress did with the CARES Act was in many ways to provide that bridge financing or that bridge help. So in the nature of people, they provided, expanded unemployment benefits. They also provided, payroll protection. So more money was going to people that was basically at their current level of of spending. And over in the Fed, the facilities that were set up there were in many ways also not to spur new activity, but to maintain activity. So, if you come from it from that background, you sort of get the point of what Washington was doing and what the problems are. We obviously have some issues with the program. We're very, supportive of the help that has gone on through these programs to people who lost their jobs, to businesses that were shuttered, and those were good. But one of the glaring problems that we see, and we think this is a very important fundamental underpinning of the economy and the financial system, and if we don't straighten it out, it's going to infect the system in a way that will be very, very costly and difficult to correct later. And that is what we would call the rent obligation chain. And because of what's gone on in the country, both because of mandated moratoria on evictions on the residential side, or businesses that were mandated to be closed by the government, or businesses that just closed for the good of all of us and from a health point of view, rent is not being paid. Some because people don't have the money, some because people are scared, businesses are hoarding cash, and all of this is logical. But that rent obligation chain needs in some ways to be restored, because it goes to the very foundation. It allows landlords obviously to pay their maintenance workers, security workers, et cetera, to meet their utility requirements for state and local governments, to support lenders. The servicers we know all about are having a difficult time meeting their obligations for investors, and on it goes. Values in real estate, and maybe we'll talk about this, Roger, are a little bit, to say uncertain, might be an exaggeration right now. And so this issue about the income stream on income producing assets is very important. We'd like to see that corrected. One last thing, and then we can get further into this, but the bill itself, provided loans to qualifying small businesses, and those loans could be converted into grants, which means you don't have to repay the loan if you use the money to pay your utilities, your taxes, your rent, and your payroll. Unfortunately, when it got downtown, as we say in this business, off the hill and downtown to the regulators, they imposed a restriction on that money that said no more than 25% of the loan proceeds could be spent on anything other than payroll. And so when you ask, are there things in that bill that we would like to correct, we would like to get rid of this cap on the ability to use money for anything other than payroll. And that is not to suggest at all that we do not want the employees or people to get the kind of money that they need to take care of their families and so forth. So there are problems, but again, it's not designed to stimulate. It's designed to, bridge us to the next world, or that was the original intent.
Now, Jeff, you raised a good point in terms of the 75-25% split in terms of the debt forgiveness. So I assume that is going to what you were talking. Debt forgiveness with respect to the rent component then on the PPP versus it being slanted all towards payroll.
Yeah, Roger, I hate to say this, but you broke up a little bit, but I think I got the question. This business about rent, I mean, keep in mind, maybe I missed the question, but I'll answer it this way. In kind of my work, I've been around a lot of people in public life, and they're going to answer any way they want, regardless of the question. So here's my answer, imagining the question is correct. Tenants are going to come out of this, if they're not paying rent now, or if they're in the situation on the residential side where there's a moratoria on evictions and people aren't paying rent. This rent burden is not going away for either individuals or for businesses. It's being added on, basically. It's being accrued. And people and businesses, if we don't correct this in some way, are going to come out of this where we're going to have 30 to 50 million people unemployed. We're going to have weakened businesses. We're going to have new ways of doing businesses and social concerns that are going to constrain the way that we do businesses. And the last thing that we need really is this added burden on tenants that, people who have been out of work. Now the economy restarts, and not only do they have their ongoing obligations, but they have a huge slug of accrued rent. Same with businesses. So we have to deal with that in some way, and that's the point that I'm trying to make, that we have to find a way to reestablish this rent obligation chain in a way that does not burden people, does not burden the people that we need to be in a position to restart once the signal is given. I hope that answered the question, Roger. I'm sorry I couldn't hear you.
It did. It did. Now, do you expect that Congress is going to be passing another stimulus bill, Jeff?
Well, yes, I do. But again, I would come at this in a way that, press and shorthand don't like to talk about. But I do not consider the action so far by Washington to be stimulus. It's been maintenance. It's been bridge financing. It's been stability. It's been trying to get us to the point where the virus will, in some ways peak, and or maybe we'll find a vaccine or what have you. But that's what it's about. I think that there is a growing realization now of the depth of the problem, and so the future bills, I do think, will be focused on kind of the following areas: figuring out what types of individuals and families and businesses have not been provided any assistance during this crisis, and we've got to fix that. Then point number two: how do we get activities restarted? And it's going to be different than in the past. I mean, we're not in the past, you might say we need to stimulate, people going to malls or stimulate people doing this. I think that's going to be a very difficult thing to do this time. We also have a situation where Congress has spent or allocated a couple $1 trillion here, I believe. And there's a growing fatigue, I guess I would call it fatigue in some quarters on Capitol Hill about spending additional money. Now, they will have to, but there is fatigue. There's a growing awareness of the problems in state and local government. So I think that future bills will have to deal with that in a more substantial way, perhaps. And so, yeah, I think there's going to be another bill. Will it be more stimulative or stable? I think it will be more on the stimulative side. You might ask, when's that going to happen? Congress comes back next week, at least the Senate does. And I think discussions will begin rather quickly on filling the gaps from the earlier bills and figuring out how we go forward. But I do not think that it's going to be instantaneous. I think it's going to be, there's a lot of contentious issues that are now coming up concerning liability when we reopen. What are the liabilities of business people, of employers, of owners of buildings, and so on? What are the real areas that need to be focused on here? So it's going to come up. It's going to be slow, and this is going to be a long slog, unfortunately.
Now, Jeff, in terms of the next bill, what type of items does the real estate industry want to see? Like, I know we talked earlier, for example, are you going to want to see items related to potential liability issues? Because I know that's going to be a very big issue for both landlords, tenants, etc., to make sure that if something happens, they're not on the hook for an astronomical amount of damages.
Yeah. Well, again, going back to the PPP, if we could correct the PPP and if we thought it would be done in a timely basis and to be helpful, we would look at that 75% restriction and urge that it be scaled back, give more flexibility to businesses on how they use that money. I think that'd be very important. I think that the aggregation rules, which a lot of people and businesses have heard about, where if you've got more than 500 employees, you can't qualify unless you're in the restaurant or the lodging industry, basically. And that creates a lot of problems for real estate in terms of somebody may have, a number of buildings that they are operating as separate partnerships or LLCs, and you're aggregating all of that up so you don't qualify. There's a lot of what we would call retail, maybe they're not mom and pop, but they need some help here. And the aggregation rules are stopping them. So we'd like to change that. And by the way, we'd also like to disaggregate. There are businesses that would like to disaggregate. Maybe some part of their business is doing fine and another isn't doing fine. and they want to do that. So we've got a lot of things in the PPP itself that we'd like to change. Look, when we get reopened, and we want things to happen, we're going to need to make sure that we can get activities financed in America. And just after, as occurred after 9/11, after the terrorist attacks, we found out that the insurance industry could not provide cover for terrorism any longer because they couldn't actuarially determine when a terrorist attack might occur, how much it would cost, and so on and so forth. And so the government stepped in because, as we all realized after 9/11, you can't finance anything, you can't refinance anything, you can't acquire anything if you don't have insurance on it, and lenders would require this kind of cover. So the federal government stepped in with a backstop plan after 9/11, and we were very involved in that. And so on a going forward basis, in this situation, we think it's very, very similar. We think that businesses, particularly construction activity, refinancing of buildings, refinancing of retail centers, and so on and so forth, the lenders are gonna require some sort of protection against the pandemic rebounding, coming back, or against a new pandemic. So we definitely are working very, very hard on trying to figure out how to backstop this coverage. And it may take the form of a terrorism risk insurance program. It may take the form of, after World War II, for example, the War Damages Corporation was set up to provide assistance there. And there's a variety of things going on. But the bottom line is, if we just want the basic things that we want, we'd like the PPP to work as robustly as it can. We'd like it to work for us, and we'd like to work for our tenants. But we've got to be prepared on a going forward basis. This is going to be a tough time to get the economy up, and the financial world is going to take some hot hits here in the next few months. And so we need to be able to have them confident to come back, and that's why we want this pandemic risk insurance thing. And by the way, we're not looking for necessarily direct real estate subsidies or incentives. Now, that may come at some time, but we are a derivative of the economy, and the economy was doing pretty good, and real estate was doing pretty good until all of a sudden we have the almost overwhelming cessation of income in America. Hopefully, the income chain can be reestablished, and hopefully business can resume. So we want things that will help the economy. And when we look in the future, we also see infrastructure, and we think that another bill, maybe it's not this next one, but it may be one down the line, that should focus on infrastructure and get people working again. There's going to be a tremendous number of people out of work, and infrastructure is a way to help get people to work. So that's what we're looking for now. But again, I would say number one is we are working very, very hard and on a proposal that we're close to going in prime time on, that we think will reestablish the rent obligation chain. It will do it in a way that is predominantly helpful to tenants, but it will help all of the entities along the way, including landlords, lenders, state and local governments, servicers, and investors. And if we can solve that problem, we'll be extremely happy.
Jeff, on this next question, it's from an audience member. Is there anything on the next bill that you want to see that will help with the debt markets? Like, I'll give you an example. In my practice, when these loans are deferred, the 3 months of interest deferred, and let's say it becomes 6 months, that gets put onto that interest effectively. If the loan is a P&I paying loan, at the maturity, that loan's going to be upside down at that point. In terms of the balloon's going to be a lot larger. So it's going to make, there's now refinance risk that's been put back into the market on a lot of these loans. Is there anything that the roundtable is looking for that might help in those areas?
Well, yeah, a couple of things. I mean, first of all, we haven't even talked about what the Fed is doing in terms of their lending facilities. And one of those concerned the term asset lending facility, the so-called TALF. And the TALF does not make loans, but it it provides the undergirder support to lenders. And one of our issues there early on was to try and get the TALF to be extended to investment grade CMBS, because the CMBS market obviously has been battered and hit very hard and shut down effectively. We were successful in getting the TALF extended to AAA rated legacy CMBS loans, but we'd like that to go deeper. And we think that, our point of view on this is if we can get a secondary market functioning again. And the reason it's not functioning is what we're talking about. There's no price discovery. There's no way to determine what these bonds are really worth anymore. We know what they used to be worth, but we don't know what they're worth anymore. And so we'd like to get the secondary market working as much as possible, and that will ease up on the originating market and give some comfort there. Some of the issues you're talking about relate to taxation. There's going to be a tremendous amount of real estate debt, well, debt of all type, but real estate debt in particular, that will have to be restructured. Some of that is in pools in the CMBS market, and some of that is not. And there's restrictions and rules that apply to all of that. In the servicer area, basically, you can't make any substantial modifications to the mortgages in those pools. If you do, if you do it, basically you can blow up the trust, blow up the REMIC. And we've started down the road on this, and Treasury and the IRS has made some initial positive statements on this that won't create a problem, but more there needs to be done. And then on the primary lending side of things, same thing. What are the rules regarding cancellation of indebtedness here, and how can we ease up on that? We have a whole program and series of proposals in this area that we think will help. But again, the bottom line is, if somebody has borrowed money and now they're not repaying the full amount of the borrowed sums, in theory, there is income to that person. How that's dealt with and how it's addressed. We had this in the 08-09 situation as well, and Congress did a broad scale, not deferral, but forgiveness in many cases of restructured debt that would have resulted in income. And maybe we'll go down that road. We have to see how big this problem becomes, I think.
Now, this moves on into the next topic, which I think is nice in terms of, do you think there's going to be enough done in Washington to rescue us from either a U or a W-shaped recovery, Jeff?
Well, I think that, first of all, I think that what Washington has done has been rather startling in its breadth and in its speed. I think that a lot of things that, if you just go back to the financial crisis, took a lot longer to set up, have been set up here quite quickly. And I think that, so I think they've done a good job there. Has it been perfect? No. Should they do more? Yes. Is it going to be enough to let us spring back quickly? A lot of this, I'm not sure, depends on Washington necessarily and public policy. People's lives have been turned upside down, and their comfort in interacting and the way that they do business has been turned upside down. And so, restaurants reopen? Who's going to go? How's it going to be? How's it going to be spaced? What about malls? What about getting on airplanes? What about all of these things that really are not public policy necessarily? They're social changes that every American, probably everyone in the world, is reviewing their interactions. And so will it be a V or a W or a U recovery? I don't know. I would use these metrics, I guess. We are rapidly coming to, I guess, in May, the headline unemployment number in America will probably be 19 or 20 million people. That's astounding. During the Depression, the top unemployment percentage, I believe, was 25%. So just using that metric alone, this is a very serious thing. I think that while it's possible that we could resume and come back quickly, I also think it's likely to take a long, long time. A lot of people have been unemployed, and we all know the old adage of fire quickly and hire slowly. So you know, I'm more interested not in a recovery. I'm more interested in providing a floor under the economy to make sure that it stops falling. And I believe that it's in jeopardy right now. And so we want to stop that rather than think about how we can all get back to our lives as it used to be, because that's going to be a long period of time, I think.
Now, Jeff,
And by the way, that's not, I'm not wishing that or anything like that. I'm a very optimistic person, and I am optimistic about all this. But I do think that in order to be optimistic and in order to enact policies and to talk about things in a rational way, people need to be realistic. And this is an enormous economic hit that has occurred certainly in certain places around the country. Very, very bad. And how that is reestablished and how we go forward is going to take time. And I think we have to just understand that and work to get in that direction.
now, how do you, in terms of after this pandemic is over, how do you think this is going to fundamentally alter real estate in general? Whether it be, as you were just saying, the mall, that's, for example, the office space environment. There's been this move during the past years of making offices smaller, more efficient, where people are more on top of each other and have the same size offices versus the old style, bigger office. I mean, do you think we're going to go back to that, or is it
Well,
going to be more people, do you think, working at home now? Or
I think that we all have realized that during the day our houses make a lot of noise.
yes,
Right? But we've realized that a lot of business, a lot of people can do a lot of work without being in the office. Now, what that means going forward, I don't know. A lot of people don't like to be home all day either. So maybe they would prefer to go back to the office. But I do think that there's going to be a rethinking of office use, of the open floor plan, for example, which was obviously the trend. Are we going to do that? What about co-sharing of office space? I mean, are people going to want to share workspace with someone else? They don't know if it's being cleaned properly. They don't know what's going on. So there probably will be some rethinking of that, I would think. Proper spacing of employees, and all buildings and all building owners are going to have to think about their cleaning protocols. Their how frequently do they disinfect? I mean, obviously regularly now, but maybe it's going to be more regularly. How are we going to test people? Are we going to have thermal heat things to measure people? So there's a lot of things in that area, and it goes to the restaurant business, it goes to the shopping mall business, it goes to everything. But I think that in the office sector, where arguably people could still go to their offices because buildings were not necessarily shut down. You could go to your office, but a lot of people didn't, and a lot of businesses conducted their office. There's one other interesting thing that I heard the other day about maybe the notion of a corporate headquarters and so forth is changing, and how many people you have in your corporate headquarters and how many you need there versus what people are doing today. So I think there's a lot of rethinking, and again, our industry is pretty resilient and pretty smart, and I believe that we'll meet the challenge.
now, Jeff, what do you see happening in terms of, after all is said and done, in terms of what's going to happen with the debt markets, particularly the CMBS world? Because we know what happened in 2008 when CMBS effectively shut down, and it took a number of years for it to get back up and running.
Yeah.
And I know, for example, I'm local counsel on a transaction that was supposed to close in April, now supposedly closing in May to be securitized, and it's on hold, I believe, because there's pricing issues.
Yeah. Well, again, the TALF, when it was extended to AAA legacy securities, immediately spreads came down. And in some of the other asset-backed secondary market, not set CMBS aside, but student loans, credit card receivables, car loans, they were distressed as well. But when the TALF is being extended to them, those secondary markets have improved, but they're different than ours because, again, we have the problem that you can't predict income on these assets right now. And so it's very hard to discover price. And if it's hard to discover price, it's hard to transact business. And so in early March, we saw spreads gapping out. Well, to call them spreads is probably an exaggeration also because there were offers, but there would be no bids. And there would be no bids because price discovery was impossible. So the debt markets, I mean, if you're talking about the CMBS market, again, it's going to require a reestablishment or some sort of floor in incomes from the properties in order to entice investors to come back again, I think. Now, if we could get this Fed to extend the TALF to other investment grade CMBS, that would be very helpful and help restart that market. I hope I answered the question, Roger. I kind of feel like a recent politician who, after you get to the end of their answer, you sort of forget what the question was. But I tried.
Actually, this leads into my next question, which is, I think what we're getting at here is the underlying problem we're going to have in real estate is how do we value the assets we're loaning on, we're buying at this point.
Right. I mean, and people, this is something that, I absolutely. How do you value? I mean, we know what rents were before. We know what the contracts and leases are on buildings, but we don't really know what businesses are going to survive and what aren't. We don't really know whether some of these people who have lost their jobs in urban areas, who maybe weren't natives of that urban area, and they might have gone home to ride out the crisis, are they coming back or not? Are people going to shop in the same way? So all of this income, discovery is really, really important. And it kind of gets to what I guess if I had a complaint about, and I really don't, but if I had to dream up a complaint, a serious complaint about Washington's reaction so far, I would say that in many ways they were misunderstanding the problem here. The problem in the financial crisis, and we're going back to the plays that were used in the financial crisis to get us out of the problems. In the financial crisis, the problems were largely over-leveraged situations. They were largely financial gimmickry, you might call it, by Wall Street. It was largely rating agencies and other regulators not doing their jobs up front. And it got us into this enormous liquidity problem, and it impaired credits, it impaired values, but the values were impaired because of the financial system and the liquidity problem. That's not the situation here. The situation is the credits themselves have been devalued because the income's not there. And so the solution of focusing on the credit markets as much as we have, and again, this is not a heavy criticism, but that's not the problem. The problem is what we're talking about here, Roger, which is the income streams and value determinations, and the credits themselves, the assets themselves, are impaired by lack of income. Unlike in 08, 09, when the credits were impaired by lack of financing. And so that's just a point that, is kind of a picky thing for me to bring up, but it really goes to the heart of all of this. And until we have that, our industry, until we have that income stream in some way reestablished, we're going to have a difficult time financing and transacting business, because people want to know, when you buy a building, you're buying an income strip. That's what you're buying. And what is the income? We don't know.
So what I'm hearing from you is similar to when we talked earlier about the PPP, is that really what we need in real estate is more of a guarantee of the rental stream at the lower level, because that then brings everything up, gives us values, predictability, and the like.
Well, yes, but it's not only the building owner that needs this assistance. It's the individuals and the businesses. Yes, they've gotten this money in order to help them weather the storm, and it's very, very good. But And again, I'm not criticizing. I think that they're very, very rational decisions being made by people. Should I pay my utilities? Should I pay my rent? What's going to happen in the future? Maybe I should save money. Wow, I don't know what's going to happen. So people are paying their rent, and but they're going to have to eventually. And so what I'm talking about is something that can relieve that future burden from the renters. Figure out a way to relieve their burden, and then it flows through the chain to the benefit of everyone. But the main point is relieving the burden from these tenants, so once we do restart, they can be as healthy as they possibly can be, which is not going to be very healthy anyway. But if we can relieve that burden, and then we can help throughout the chain, and we can have a sound, at least for a period of time here, a floor would then be created under values, because the income stream has been reinstated on these assets. And that's really the goal here. And I know it's a little hard to follow because I'm not at liberty to go into all the details of what we're trying to, develop here because of a lot of different reasons. But that's the theory, I hope that
And
helps.
that would seem also, Jeff, to the extent we move per protections for, let's call it the little guy, the tenant, that would help with effectively getting people back to work and off of the unemployment rolls again.
Absolutely. I mean, businesses, and there is and rightfully so. Again, I think if we were politicians, we might have the same point of view about helping people versus helping businesses. But right now, the view is definitely helping the workers and not the employers directly. That probably will change coming up, but that's the theory so far. And, I, I think we're
Effectively,
all
sort of
sympathetic
like,
to that. People are in trouble and they need help, but we can't let this get so bad and out of hand that it infects the overall economy and, more importantly, the financial system.
so really what you're saying is we protect the underlying small businesses, which should then have the trickle down effect and a trickle up effect and benefit the entire economy.
Roger, you have a future job as a lobbyist. We like the way you stated that, and it's true. And think about these businesses again. If we want to get people back to work, businesses, which are going to be, they're going to have enough structural problems once we reopen. Whatever those structural problems are, if nothing else, they're going to have to reconfigure many businesses just to accommodate the new social distancing rules, et cetera, et cetera. And so, why do we want to burden those small businesses with accrued rent? We want them not to have that so that they're able to hire people, so that they're able to make the improvements in their businesses to respond to the new way of transacting business. And so I think it's very, very important to lighten the load on people and on businesses in a way that will go up the chain.
Now, do you see things being done in other countries that you think we should be following in terms of support for their economies?
Well, everyone around the world is kind of dealing with the same problem, and there are a lot of proposals out there. There's a proposal, I guess it's either Canada or Europe or maybe both, but they have a proposal where the governments are just going to, they would require tenants to pay 25% of their rent. Then the government would pay 50% of the rent, and then the landlord would eat 25%. So 25, 25, 50 is what Canada and Europe are talking about to address the problem that I've just identified for you. And, excuse me, maybe that's an approach that we will get to here as well. I think, right now, the view is a lot of tenants don't have the 25%, and a lot of landlords don't want to eat 25%. But again, that may change. So, looking at that, at one point in time in London, in England, I believe that the Crown, as it were, said that they were going to pay 80% of rents owed by impacted tenants. I don't know if that's gone forward or not, but these are not unique problems to the United States, is the point.
No, which again, it seems to me that there's going to have to be significant tax policy woven into this as well, so that if people are expected to take losses on these types of items, they get some sort of tax relief, I'm guessing.
Well, again, that did come up in the financial crisis. It was addressed by Congress in a pretty aggressive way, and we may be in that situation again soon, where they'll look at it very carefully. It's not
Oh,
something that people are unaware of. Let me put it that way.
I'm looking at a question from one of the from the audience now, and I've thought about this also. Do you think there are a lot of tenants out there that are just using this as a reason not to pay rent when they are
Well,
completely capable of paying rent?
I'm sure that, look, there are opportunists in everything, right? Um, I think that there are opportunistic businesses and people who could pay rent who probably aren't. On the other hand, I think that the vast majority of non-payers so far are people that are truly impacted by this. Um, and then there are other people who I think are legitimately frightened. And um, and we can just look at what's happened in corporate America to determine whether what I'm about to say is rational. In corporate America, any business uh, that had a line of credit that was not tapped uh, has drawn it, whether they're using the money or not. Why are they doing that? Because they're hoarding cash because they don't know what the future is. And so, if businesses with smart, sophisticated investment and operational people think that it's smart to pull down a line of credit, even though they don't have a place to use the money, I don't think we can criticize individuals for hoarding their cash either. So, you know, yeah, I suppose there are opportunists out there, but I think they're the minority, frankly. And by the way, you know, rent collections, here I am harping about rent. Um, you know, the retail sector is obviously where the rent problem is most severe, and collections there probably nationally, I don't know, certainly below 50%. But in multifamily and office last month, they were around 70% collections. Now, that was last month. We'll see what they are as we enter into May, and rents due tomorrow or the next day, whatever it is. So we will have data pretty soon on whether there are the tsunami of non-payment in rent that we believe is coming. We could be wrong, but and I hope we're wrong, but I suspect not. By the way, back on the PPP, I did forget to mention one little thing, and it goes to this point. In the CARES Act, there was a moratorium on evictions for any residential tenant in any building that had federally backed financing. So, an apartment building with Fannie Mae, Freddie Mac, Ginnie Mae, what have you, financing on it, moratorium on evicting of all tenants in that building, regardless of whether the tenant was impacted by the virus or not. Landlords were allowed to get forbearance from their lenders, but they would have to show economic. They would have to show the virus damage, and there's some symmetrical differences here that are creating problems. And while I'm on that, I would say that forbearance by lenders clearly is a problem, but is being worked out in some situations on a case by case basis. Lenders and borrowers are working out their differences. The FDIC and the OCC, CUNA, and others issued a statement encouraging these are the regulators of the federally regulated credit sources, and they did tell their lenders that they regulate to be flexible with borrowers and to restructure loans if they could. And they went on to say that they would not criticize or mark down that kind of activity as the regulators, and that's very, very good. And I think it's having some positive impact out there. But keep in mind, a substantial amount of real estate credit, certainly since and because of, in many ways, the financial crisis. Now financing is coming in a big way from unregulated sources, whether and we all know, whether it's pension funds or life companies provide a big source, they're regulated by 50 different regulators. So to get them to act in unison is difficult. But again, I've forgotten the question, but I did make an answer.
Now, this is a question from the audience, Jeff. In terms of the structure of the CARES Act, in terms of the timing and the length of it, do you think that the bridge that's been established has been long enough? Do you think the government took, or do you think it's going to have to be effectively extended again in a couple of months?
Yeah. Well, hard to say, right? I mean, there are roughly 10 states, I think, that are doing some form of limited reopening next week. We'll see how that goes. If it goes reasonably well, and if it does not result in, a restarting of the virus and the pandemic in those states, I say restarting as if it's over. It's not over at all. But, then clearly we're going to have to extend this bridge beyond July, where it currently ends, basically. So I don't know. We'll have to see. But certainly some areas in New York City clearly hit very, very, very hard. And we all know the connectivity that it has. Here in the D.C. in the metro area, I believe that we're still kind of trending up. The curve has not started to bend yet, I believe is the situation. And maybe that'll be in another 2 weeks or something like that. So, and other parts of the country where that curve is flattened. So I think we just have to be optimistic that the bridge works to get us through that situation. Then stimulus and revamping and reorganization will take us on the next sort of economic phase. That's how I look at it.
Now, do you think, Jeff, I have another question from the audience, but this is my personal question. Do you think that the government will finally focus on, take this opportunity for the stimulus bill to focus on infrastructure, which we all know is badly needed?
Look, the argument in Washington for years has been, okay, we all agree we need to do a major infrastructure program, and that includes roads and bridges and internet and water and sewer and everything. But, oh my God, we can't do it because how would we ever pay for it? It's too expensive. We can't pay for it. So on the one hand, if what we're now in is a period of time when Washington largely doesn't care, and I don't want to overstate that, but that's not the driving factor, how we pay for it right now. And a lot of this stuff has been put on the credit card. So one could argue that infrastructure fits the program, will put people back to work quickly, and should be the centerpiece of a program going forward this summer at some point in time. I'm not sure that's really going to play out. Leader McConnell has said that he doesn't think a infrastructure program should be part of the next stimulus. And I don't think it'll be part of the next stimulus either. I think it will be, later on if it comes up. I know that the House Democrats would like to propose an infrastructure program, and we would like to see that. So hopefully it can be wedged in there, but I don't think it's as easy as simply looking at it and going, oh, we don't have to pay for things anymore, therefore we can do it. Unfortunately, it's going to have a lot more pushback, I think.
Now, I have a question from the audience for you, Jeff, asking what you thought about the director of the FHFA's comments regarding letting loan originators effectively pay off CMBS investors even if it causes them to fail.
Yeah. Well, I think this goes to, and we've seen this kind of thinking in some of the other programs that have, in all of the programs, I guess I would say, the idea that, there may be a strain of thinking. I'm not saying it's there, but it may be that, the thought is that the servicers should have been more better capitalized in order to meet these problems. And why is the government rewarding companies that were not well capitalized? And so, I get where they're coming from, and they're they seem to have made the decision to let them sink of their own doing. I think it's very, very bad because when those servicers meet the capital call, basically is what it is from the investors, either they don't have the money and they're going to have to liquidate positions in other assets that they have, and liquidating those positions in a distressed market is not a good thing, and that further drives down marks down things. So I'm not in favor of it, but you've seen this in the PPP where companies that took money, this thinking anyway, in where companies that followed all the rules, they didn't do anything that was not in the rule book. They applied for the loans, they got the loans, and then lo and behold, there's an outrage that some company, and we know what Shake Shack is the kind of the pinata here, but there's many, many others. And people say, well, you could get money elsewhere. You've got this, you've got that. Public companies, well, you can go to the public markets and get. We're not going to help public companies, and sink or swim. And I don't subscribe to that view really, although I do think people should have been better capitalized. Restaurants, for example, I think only have about 30 days of ready capital if they get shut down. Is that the right buffer or not? And again, going forward, I think we're going to rethink. People will rethink a lot of things about their situations in terms of spending money and the debt that they take on.
Now, Jeff, you're an expert in the real estate industry and also an enthusiast about our industry. Have you been reading any books during our stay-at-home orders? Or anything that you would recommend for any young people who want to use their time productively to learn about the real estate industry?
Well, the only book that I've been reading recently is called The CARES Act. You might want to pick that up and take a look at that chapter on PPP is really interesting. So I've been reading that. I'm not really necessarily reading any books that I could pass along to you, but I am reading a book, but I read sort of odd things anymore, and I like rock and roll books, and I'm currently reading Flea from the Red Hot Chili Peppers book. He's got a biography out that's actually pretty interesting called Acid for the Children. And by the way, let me just say this. So I'm reading that book. It's really interesting. It's got a lot of life lessons in it. But one thing that I did not say earlier is if anybody wants details about any of the stuff that I've talked about, please go to our website, www.rer.org. And we've got a whole page of all of these kind of and more policy issues, all of our letters, all the things that we're focusing on. You can see it right there. I don't care if you're a member of the Roundtable or not. We want to get this information out. And getting back to the book on Flea and the Red Hot Chili Peppers, I guess you could say that based on what I just said, we give it away now.
Now, Jeff, we're getting closer to one now. This is coming from Roger. In all these downturns, there's always winners and losers that come out of it in the real estate world. What I'm seeing is that in our industry, retail is getting hammered. The hotels are getting hammered. Office, I think the jury is out, but I would think that in certain industries, like maybe industrial, there's going to be tremendous demand, particularly with everything moving online. So yeah, I think in terms of that aspect,
there are definitely going to be a lot of winners and losers in this, which, again, I think that in the financial crisis, it was easy to pick on some companies who may have been over-levered or doing some financial gimmickry or so on and so forth. Picking winners and losers in this situation, I really don't think is right because and I just went over some of the things that.
Well, I didn't mean it like that, meaning a winner or loser. I should have termed it differently. What areas of real estate would come out better than others?
Oh boy! If I answer that, I'll lose a lot of members. I can't do that. I think everybody listening knows the challenges to each of the asset classes in the industry, and and we can make our own judgments on which one of those asset classes is going to be more burdened or less burdened coming out of this.
All right, I'm going to hop in here as we are just approaching the bottom of the hour. Jeff, I'd like to thank you very much for joining us for this webinar. It was incredibly informative, and I know that our audience got a lot out of it. Roger, thank you so much for leading the conversation. For everyone that tuned in, our deepest thanks as always. Check in with us next week. Next Tuesday at 11, we have a webinar with Oliver Carr. And then on Thursday at 12 p.m., we have a conversation with PBS Commissioner Dan Matthews. So both great conversations that you don't want to miss. So tune in on those. Stay safe, stay healthy. Everyone have a great weekend, and we'll see you next time.
Thank you. You too.
Thank you very much. Thank you.
Thank you, guys.